Hi, everybody. In this video, I would like to discuss the value of having an unbiased bias when it comes to your analysis and trading. It's mostly a topic on psychology and the mental aspect of trading, but it relates to your analysis as well. Okay. Um, these kind of subjects tend to be dry a little bit, but those are usually the most important and crucial topics when it comes to making it as a trader. So I think most of us are familiar with the word bias. For those that aren't, basically in the context of trading, all it means is being in favor of the market, moving either up or down. Okay, so your bias comes by means of analysis and can be related to any time frame. For example, I could have a bullish bias on the monthly chart and a bearish bias on the daily chart. Okay, now you don't always have to have a bias. If you don't know, then you simply don't know, and there's nothing wrong with that. It would be unreasonable and nonsensical to think um, that you should have a bias at all times. I don't always have a bias. I only have a bias when the chart shows me, and it's not just related to your experience. Nobody has a bias at all times, and if they do, it's never right all the time. Okay. Sometimes your bias is wrong, um, which leads me to the topic of this video. People tend to how do I say this? People tend to get stuck on their bias, basically. Um, but I believe even for traders who don't know how to form a technical bias, they do so anyway in the form of a psychological bias, right? So if you're going to get into a trade, you either think the market is going up or down, regardless of whether it's analytical or based on a gut feeling. So the tricky part is being flexible and changing your bias when the market is indicating you are clearly wrong. So smart money knows how we think, and they know how to create sentiment in the marketplace. Um, as we know, or at least smart money traders believe that liquidity is what moves the market, and it is. Liquidity is the lifeblood of the market. Players with big pockets, they need liquidity to get in and out of positions, else it would not be worth it for them. Okay, so it's crucial to be able to change your bias quickly when it is applicable, when your analysis is showing you, and not for any other reason, not based on FOMO or greed. That's not when you should be changing your bias. Okay. So being flexible is good because you can be early to the party, basically. You can catch more pips and you have a higher likelihood of your trades panning out. If the move is about to end and you're still trying to get in, then, you know, expect less wins and less profit. So, right, as humans, we tend to cling to our beliefs. We block out any evidence indicating that we may be wrong. And when the market is showing us that we may be wrong, we just tell ourselves, well, the market is offering me more pips now. I have to get in on the move. Hence, one reason how you get long or short squeezes, right? If the market's always going up and you're still trying to short, that's bad. It's bad for you. Or if it's going down and you're still trying to long. So sometimes you got to let go of those beliefs and you got to change. And if you're still feeling emotional about it, at least stay out of the market. So, all right, now I'm going to go in the chart and show you a bias I've had and what it would look like if I did or didn't change my bias. Okay, and you can apply the same type of logic to whatever concepts or technical analysis that you use to trade. Okay, so here we have the gold chart, XAU USD data from forex.com. I wanted to use the replay tool for illustrating, but TradingView didn't allow me to post, so I'll just do it this way, right? So as you know, I'm an ICT trader, and I trade based on ICT's concepts. One majorly being the concept of liquidity. Where does liquidity lie? Above equal highs and relative equal lows, where retail traders may think of it as support or resistance. So, as smart money traders or ICT traders, we attack that. We attack that um, type of sentiment and use it for our targets and sometimes for entries as well. Okay, so at this point here, I saw price coming up on whatever the daily time frame, and I saw a rejection. So I wanted to take a continuation to the upside to attack this liquidity. So I had a couple of areas here. We use things like inefficiency, such as these gaps, as possible areas to take trades. So I think I got in a trade here, and I had a reaction on the lower time frame, but eventually price started pushing lower into this gap, uh, consolidating, coming up, leaving more relative equal lows, coming up without much of a gap created, and then expanding lower. So I think I took a loss somewhere in here, and at that point, if I did not let go of this bias that I had, I would have lost, a lot more money. And I did still have a bullish bias. So, but because I was still holding on to this bias and feeling emotional about it, I decided to just stay out of the market. Okay, so I did not change my bias to being short just yet because my mind was not yet clear. So this is something that's very important. If you're feeling very adamant about a bias and it's difficult for you to change that bias, and if you're still unsure what's going to happen in whatever asset you're watching, just stay out. You do not have to get in just yet. There are plenty of opportunities, and the market will eventually give you one again. Okay, especially when you're a bit more in the right frame of mind. So I did not get into this uh, short over here, but I saw price expanding lower, came to take out these relative equal lows over here, um, created more sell side inefficiencies, and started moving lower. One thing I did not see, or kind of swept the back of my mind, was the amount of relative equal lows here. See price coming down once, creating this relative equal low liquidity pool, coming down again, expanding higher. Even one more time, I can imagine trying to go short, trying to take out this low and or these lows, and getting stopped out. Um, at this point, from here to the top is almost half a year, and after a while of having a bearish bias, I think at this point I'll be switching to a bullish bias. But you can imagine if I'm still targeting the top and price comes all the way down first for another almost 1 year again, a little bit more than half a year. So price comes down, takes out the sell side liquidity pool, and eventually moves up towards the upside. It takes out this high, the liquidity here, and this high as well by a little bit. You can see over here. But again, it's not enough in the grand scheme of taking liquidity for smart money. If you look at the chart, there's a lot of time has elapsed where they have gotten into their positions, accumulated more positions, and they're accumulating here. And they're distributing here. But this small move up, that's not enough for them to fully offload their positions. But they've offloaded some, and here they're changing the sentiment to bearish again. And here they're accumulating again and then expanding higher. So now price comes up to here, pierces through and gets rejected, inducing more shorts. They reaccumulate here, price goes up more, and again they're distributing their positions. And this is where price is now. Gold is at relative all-time highs. So you can see how if I did not change my bias, how I could be getting wrecked. So this is the daily time frame. Everybody trades on a specific time frame. You don't have to wait for this many candles to pass. There are biases on the 1 hour, 4 hour, etc. Okay. So whatever type of strategy you use to trade, if the market is showing you that you're wrong, don't get into another trade unless all the working parts of your trading system are being checked off, right? Your signals for analysis, your entry, stop loss. But very importantly, if you feel too strongly about a bias, if you feel too strongly that the market is going to go up, most likely that is manipulation, and it's time to sit on your hands a little bit and wait for the manipulation to finish before getting back in. So either you're right and it just takes a little bit more time for the market to do its thing, or you're wrong. So either one of those things will still offer you the opportunity to either get back in to the move, or stay out, or change your bias. Okay, so yeah, I hope you found this video useful and insightful. It's quite an important thing when it comes to trading. So I hope you ever think about it. If you need any clarification about the content in this video, or you're still struggling to find yourself as a trader and need personal guidance, feel free to reach out to me, or leave a comment, and I'll be glad to reply. Till next time, happy trading.